who has got financial years. All right, 1 second.
I think we just lost the host. Give me a minute. I'll get on touch with him over phone. Give me a minute. Please bear with us. I think, let me just find out why have we lost the host. Just give me a minute, okay?
I'm back. I think it got disconnected from my end. All right. Okay, so I am sharing my screen. Rajam, can you just confirm if my screen is visible and
not you are only visible. The screen is not visible.
Just a second.
Yeah.
Let me again come back. All right.
Yeah, now screen has come.
Okay.
Yeah.
All right.
Yeah.
So I'm back, guys. So I was here. So just do not consider this particular session as my legal opinion. Whatever I'm discussing today in today's webinar is to make you understand, is to make every one of us understand the law provisions as regards UAE corporate tax law. So what topics I'll be covering in today's session. So this is just a synopsis which I have shared here. So we'll be covering the corporate tax overview in today's session. We'll also try to understand what is the scope of tax and what is the rate prescribed in the UAE corporate tax law. We'll also try to understand who is a natural person under corporate tax law and who are categorized as juridical persons, because corporate tax is applicable not only just on juridical persons but also on natural persons. We'll try to understand that as well. How partnerships are taxed under UAE corporate tax, we will learn. How our branches and foreign persons are going to get taxed in corporate tax law, we will learn. What will be the taxable income? Is it like the accounting profit, or you need to perform few adjustments in order to arrive at the taxable income? What are those adjustments, if required, which needs to be done to arrive at the taxable income? We will learn that. We will also learn if there are any exempt incomes which is prescribed in the law, and whether deductions, if any, are disallowed or partly allowed. We will learn that as well. There are few transfer pricing rules which are there in UAE corporate tax law, on which transaction this transfer pricing TP guidelines or TP rules will be applicable. We will learn that. If there are losses in an entity, can it be carried forward to next year, or can it be adjusted against any other entity? We will learn today. We will also learn what is free zone in UAE and what is the corporate tax rate which is applicable on free zone. We will learn that. We will also try to understand the applicability of corporate tax law on various sectors like airlines, like insurance, like banking. Then what are tax groups? What are qualifying groups? What are the financial records which one has to maintain as per UAE corporate tax law? We will learn that. What are the administration provisions prescribed in the law? We will learn. And finally, what are all the opportunities for professionals in terms of providing advisory services or auditing services for UAE clients? We will try to understand that as well. So moving forward, first of all, for the benefit of my friends who are there in India and who doesn't have much idea about United Arab Emirates country, Let us try to understand the very first topic if you want to understand the country UAE. UAE is a nation, it's a country which is amongst one of the council, Gulf Cooperation Council member. So basically, GCC stands for Gulf Cooperation Council. And in GCC, you will find 6 nations which has come together in the year 1981 and signed a political and economic union. So these 6 nations collectively known as Gulf Cooperation Council, in short GCC, which includes Saudi Arabia, Kingdom of Saudi Arabia, it's called as KSA. It includes Kuwait, Bahrain, Qatar, UAE, and Oman. So all these 6 nations constitute GCC. So having understood what GCC is, let us try to move forward and understand the country United Arab Emirates. A lot of my friends used to ask me, when are you going to Dubai? Or like, when are you going to UAE? Is UAE different from Dubai, or is like Abu Dhabi is a country? They have so many questions as regards United Arab Emirates because they haven't heard the terms state, the terms cities, the terms districts when we talk about United Arab Emirates. So there is a lot of confusion amongst my Indian friends as regards the country United Arab Emirates. So let us try to understand the country first. Basically, United Arab Emirates is a collective Emirates state. So there are 7 Emirates. Emirates are nothing but, a dedicated place, we can say, which are ruled by rulers. So in UAE, you will not find the term state, you will not find the term cities, districts like that. UAE is a collection of 7 Emirates, we can say. The Emirate, Abu Dhabi is one Emirate, Dubai is another Emirate. Similarly, Sharjah, Fujairah, Al Quwain, in short, it is called as UAQ, Rak, Ras Al Khaimah, and Ajman. These 7 Emirates collectively constitutes United Arab Emirates nation. Now, the ruler of Abu Dhabi will be the president of the country, and the ruler of Dubai will be the vice president. It's like that, if in case the ruler goes, the dynasty continues. So the ruler of Abu Dhabi will always be the president of United Arab Emirates, and the ruler of Dubai will always be the vice president of the country. He will also be recognized as the prime minister of United Arab Emirates. Clear? So we'll move now to understand corporate tax. Corporate tax overview, if we try to understand, first of all, let us see what is the background and rationale of introducing corporate tax in UAE. What is the reason behind introduction of corporate tax in UAE, my friends? What has happened is, European Union, EU Commission has blacklisted United Arab Emirates, considering it as one of the nations where money laundering happens. So this has impacted the image of United Arab Emirates. So what has happened is United Arab Emirates has taken it as a challenge, and then over the past few years has taken significant steps to enhance tax transparency and also facilitate the exchange of information for tax purposes by bringing its domestic tax rules in line with international standards. So there is an organization called OECD, which stands for Organization for Economic Cooperation and Development. UAE has become a member of OECD in the year 2018, more specifically in May 2018. And OECD has come up with a project called as BEPS project, which stands for Base Erosion and Profit Shifting. So as per OECD BEPS project, what OECD has highlighted is they have figured out that many multinational companies or many people are actually siphoning out their profit from a very high tax jurisdiction to either a low or no tax jurisdictions, because of which the countries where there are high taxes, people are not paying taxes by just shifting their base or shifting their profit from that tax jurisdiction to a low tax jurisdiction. So UAE has said, okay, fine, I am also willing to become the member of OECD, and I will also introduce UAE corporate tax in order to become tax transparent. So there is basically a 15 points BEPS action plan, and UAE said, fine, I will be implementing, if not all, we'll start with the 4 basic minimum BEPS action plan, which is countering harmful practices, that is action 5, countering treaty abuse, that is action 6, transfer pricing documentation, action 30. So these are all action plans I'm talking about. So out of 15 action plans which OECD BEPS introduced, UAE has adopted these 4 action plans. So action plan 14 is improving dispute resolution mechanism. So with this little brief background, UAE has actually introduced corporate tax in UAE. And what are basically the objectives behind introducing corporate tax as per United Arab Emirates Ministry of Finance? Ministry of Finance said the basic objectives of introducing corporate tax is to cement the UAE's position as a leading global hub for business and investment. We all know that companies from across the world would like to come forward and open companies in UAE. So it's a leading global hub. So to cement its position, it's implementing corporate tax. To accelerate the UAE's development and transformation to achieve its strategic objectives. What is one of the strategic objectives? Is to become tax transparent. So to develop and transform from tax haven to a tax transparent nation, UAE is introducing corporate tax. And the third objective as the Ministry of Finance is to reaffirm the UAE's commitment to meeting international standards for tax transparency, preventing harmful practices. Now we understood that UAE has introduced corporate tax, but when will UAE corporate tax become effective? Is it like it's gonna become effective, or it has already become effective from 1st of June 2023 for all the entities, for all the business people? It's not like that. Basically, if you read the sentence here, it says, the provision says, UAE corporate tax regime will become effective for financial years starting on or after 1st June 2023. So unlike India, wherein we have got fixed financial year, that is from 1st of April till 31st of March, the companies or the businesses in UAE are at liberty to choose their financial years. So few businesses can have their financial year from 1st of January till 31st of December. Few may have their financial year from 1st of April till 31st of March. Few may have from 1st of July. So there is no restriction as such. Only thing is you need to inform to the FTA that you are choosing this particular period as your tax period or a financial year. So now, when will the UAE corporate tax regime be applicable to your business? If in case, we will try to understand this applicability with the help of 2 scenarios here. Let's say there is a business which has got a financial year starting on 1st of July 2023 and ending on 30th June. So the tax law will become effective for this particular business from 1st of July 2023 onwards, because the financial year is commencing on or after 1st June 23. In second scenario, there is a business which has got a financial year starting from 1st January 2023 and which eventually ends on 31st December. So now the first financial year which will begin on or after 1st of June 23 would be, for this case, it will be 1st of January 24. So for these kind of entities, when the financial year starts or starting from 1st of January 24, the corporate tax will be applicable to them effective from 1st of January next year onwards and not from 1st of June 2023. So they can continue run their business without falling under the UAE corporate tax regime, and they can do business. So the law applicability, the tax applicability will arise only for the financial years starting from next year for category 2 scenario. All right, clear. So this is what I have made the applicability provisions here. In the first scenario, the law will be applicable from 1st of June 23. In the second scenario, the law will be applicable from 1st of January 24. Now, who will be subjected to UAE corporate tax? We all understand that tax is applicable to businesses, to corporations, to individuals, but whether it is applicable to resident or whether it is applicable to non-residents. So all these 4 categories will be subjected to UAE corporate tax. The first one is juridical persons in UAE. So all those entities which are registered in UAE are called as juridical persons in UAE. So the law is applicable to them. If in case there is a juridical person which is established, incorporated or formed outside the UAE, but is effectively managed and controlled from UAE, the law is applicable to them as well. So the third category is there is a juridical person outside the UAE, all right, but has got a permanent establishment in UAE. In second case, the juridical persons which is being effectively managed and controlled from UAE, they will be taxed as a resident. But in third category, when the juridical person is registered outside the UAE, which has got permanent establishment in UAE, will be taxed as a non-resident person. What are the implications? We'll understand in coming slides. The fourth category, although the law is termed as taxation on corporations and businesses, the law even tax natural persons. There is a cabinet decision number 49 bar 2023, which has prescribed what kind of natural persons, resident, non-resident, will be covered under UAE corporate tax law. We'll understand it at a later slides. Now let us try to understand the scope and rate of tax prescribed in the UAE corporate tax law. In order to understand the scope and rate, let us try to understand few key terms which are prescribed in the law. What is business and what is business activity? Friends, in India, we have got different heads of income when we compute the tax, the tax liability and the taxable income. We have got capital gain, we have got business income, other sources likewise. But in UAE, there is no separate heads of income. So what is business? First of all, business means any economic activity, whether continuous or short term, conducted by any person. Simple to understand. But what is business activity? If I get a dividend, will that be categorized as business activity? If I get a rental income, will that be categorized as a business activity? The law says for the application of corporate tax law to companies and other juridical persons, right? I'm not talking about natural person here. For the application of corporate tax law to companies and other juridical persons, all the activities conducted and assets used or held will be generally categorized as assets held or used or the activities conducted for business purpose. So that means any form of revenue you get, if you're carrying out, if you are a juridical person, if you are having an entity in UAE, whatever receipts you get as part of your revenue will be categorized as a business activity. Whether all those business activities are taxable or exempted is a different story. But for the sake of understanding of law provisions, whatever revenue an entity gets in UAE will be categorized as a revenue against business activity. Now, scope and rate. Let us understand what is revenue. Revenue we need to understand because there are certain provisions in the law. All right. Am I visible? Can someone?
Yes, you are visible.
All right. Thank you so much. So
Yes,
now,
yes.
yeah, thank you. So as regards revenue, we need to understand the term revenue because there are few provisions which states that if you achieve certain percentage of revenue, this law provision is applicable. If you cross certain threshold under revenue, you will be applicable, and this particular provision will be applicable. So revenue is nothing but the gross receipts which the entity gets. It may include service income, it includes sale of goods, it includes royalties, interest, income towards trademarks, whatever. So whatever receipts you get in your business entity will be categorized as a revenue. So what is a tax period? Tax period is nothing but a 12 months period, which is categorized as a financial year. So as per law, the law says the tax period will be the Gregorian calendar year, which starts from 1st of January and ends on 31st of December. But as I've told you, entities are at liberty to choose a different period than is what is prescribed in law, but they need to intimate to the FTA that they are using this particular period as the tax period. So they can choose, effective from 1st of June, 1st of July, but they have to follow it consistently. All right. And what are the UAE corporate tax rates prescribed in the law? UAE corporate tax, categorizes the entities in UAE into two forms. One is entities established in free zone. Now, what is free zone, we'll understand. But for the sake of understanding law provision in this slide, understand that basically the categories of businesses are of two types. One is businesses established in mainland, and one businesses established in free zones. Free zones are dedicated areas which are governed by respective free zone authorities. All right. So the corporate tax rates, which is applicable to individuals and juridical persons. All right. The tax rate is up to 375,000. If your taxable income is up to 375,000, the tax rate is 0%. If it is beyond 375,000 dirhams, it is 9%. What about entities which are there in free zones? Again, in entities in free zone, you need to meet certain conditions in order to categorize yourself as a qualified free zone persons, QFZP. If an entity is a qualifying free zone person, and if they get income which falls under qualifying income, we'll understand at a later slides, of course, everything, what is qualifying income, what is qualifying activity. but the corporate tax rate is 0% on qualifying free zone persons qualifying income. If it is a non-qualifying income, 9%. There is no threshold limit of 375,000 given for qualifying free zone persons. So if you are a qualifying free zone person, if in case your income falls under qualifying income, you will be taxed at 0%. If your income falls under non-qualifying income, you will be taxed at 9%. Now, as regards the threshold limit, as regards understanding qualifying free zone persons is fine. UAE has given some relaxation to small business and small business running by juridical persons, small businesses which are running by natural persons. Now, if in case you have an entity and if your turnover is less than 3 million dirhams, you will be categorized as a small business entity. So for small business entity, when your turnover is not crossing 3 million dirham, in that case, you need not have to pay taxes, but you need to file your return. You need to intimate to the FTA, but you need not have to pay any taxes. If in case you fall under small business category. So what is small business? It's a juridical person which is established in the UAE, all right, and which can be established outside the UAE also, but it has to be a juridical person. And the revenue, the gross revenue in a particular tax period is less than 3 million dirham. You will be fixed, you will be categorized as a small business wherein you need not have to pay any taxes. If you are a natural person, I'm talking about a natural person now. If you're a natural person, even though you are running a proprietorship concern, you will be categorized as a natural person in UAE. If you're a natural person and if your turnover is less than 1 million dirham, you will be categorized as a small business and you are eligible for small business relief, wherein you need not have to pay any taxes, despite of the fact that your taxable income is crossing 375,000. I hope this is clear. Now, who are residents for the purpose of UAE corporate tax law? Residents are all UAE incorporated companies such as limited liability corporations, private shareholding companies, public joint stock companies, other juridical persons will be subject to corporate tax as resident persons. All right. So all entities which are registered or formed or incorporated in UAE is resident person. Any entity that is incorporated in the UAE will automatically become a resident. An individual who is actually engaged in the business or business activity in the UAE will be categorized as a resident. That means not everyone will be categorized as a resident. You need to engage in a business or business activity. You will be categorized as a resident. If there is a foreign company, that foreign company can be treated as a resident person if it is effectively managed and controlled in the UAE. All facts and circumstances must be considered in determining whether a company is effectively managed and controlled or not. Depends upon case to case. But these categories, one is UAE incorporated entities, second natural person if doing business in the UAE, third again juridical person outside the UAE but is effectively managed and controlled from UAE will be categorized as a resident persons. And how are resident persons taxed? They are taxed on both their UAE and income earned from abroad. Of course, they'll be given a foreign tax credit of the taxes paid abroad. Right? The income of foreign branches or foreign PE of a UAE business will be included in the taxable income. Unless the UAE business, so there is an option given to the UAE business to claim an exemption for its foreign branch profits. So if their foreign branch profits are, if in case they are paying taxes abroad, they can go to the FTA, claim that I'm already paying taxes abroad, give me an exemption. In that case, their income which they are earning from outside the UAE will not be taxed in UAE. Now, who are non-residents? Non-residents can be juridical person, non-residents can be a natural person. Non-resident juridical persons are those persons which are incorporated in a foreign country but effectively managed and controlled outside the UAE. So if the effective operations, effectively, if they are managing and operating from UAE, it becomes a resident. But if there is an entity which is incorporated outside the UAE and also is effectively managed and controlled from outside the UAE, that will be called as a non-resident juridical person. And who will be called as a non-resident natural person? If the natural person is not engaged in any taxable business or business activity in the UAE. How are non-residents are taxed? Non-resident persons will only be subject to UAE corporate tax on income from their PE in the UAE. So if they have got permanent establishment in the UAE, then that income is taxed in UAE. Otherwise, it's not taxable. And in terms of non-resident, there is a concept in UAE corporate tax law which states that if you're paying any income to non-resident, for the income which is actually being earned in UAE, the payer has to deduct tax at 0%. In the law, they have given it is as 0%. That means the transaction is brought into the withholding tax provisions. At a later point of time, whenever ministry wants, whenever cabinet wants, they can come up with a ministerial decision or a cabinet decision by enhancing the rate of withholding taxes. So as on date, there are no withholding taxes. We can say it is actually 0%. So 0% withholding tax is actually applicable when you are paying income to non-residents from UAE. There are few categories of persons which are categorized as exempt persons in the UAE corporate tax law. So these are the categories. The UAE federal and emirate governments and the departments will be categorized as exempt persons. Only government owned companies that carry out a mandated activity and that are listed in a cabinet decision, businesses engaged in the extraction of UAE natural resources and related non-extractive activities which are subject to emirate level taxation. So emirate level taxation means what happens is, see, UAE corporate tax is a federal level tax. That means the country as a whole collect taxes from these companies. But there are few activities in UAE wherein respect to emirate taxes those activities. So one of those activities are extraction of natural resources in UAE. So if the extraction is happening in Dubai, if the extraction is happening in Abu Dhabi, respective emirates will tax that income. So that is outside the purview of UAE corporate tax. If there are public benefit entities, nothing but charitable organizations which are listed in cabinet decision, those are exempt. If there are investment funds that meet certain conditions, those are exempt persons. If there are public or private pension or social security funds that meet certain conditions, are exempt persons. UAE juridical persons that are wholly owned and controlled by other exempted persons will also be considered as exempt persons. Now let us see how we need to determine the taxable income of UAE corporate tax. So the base is your accounting profit or loss. So you need to take your accounting profit or loss and then you need to perform few adjustments to it in order to arrive at the taxable income, similar to what we do in India as well. So we'll take accounting profit or loss first as a first step, and then we'll perform these adjustments. Adjustment number 1, unrealized gains and losses, if any, subject to the election made regarding the application of realization principle. So any unrealized gain or loss you have, you need to make an adjustment to your accounting profit. If you have an exempt income, you need to make an adjustment. If you have any income which is arising from intra-group transfers, you need to make an adjustment. If there are certain deductions which are not allowed or partially allowed, adjustment is required. If you are transacting with related parties, then an adjustment is required to the extent of arriving the transaction value at arm's length price. So that adjustment also we need to do. You can transfer tax losses from one entity to another entity. What are those conditions to transfer? We'll understand. But yes, if you are transferring the losses from one entity to another entity, that adjustment also you need to perform. If you have any foreign tax relief or if there is any withholding taxes, that also you can claim and perform adjustment to your taxable income. So with these adjustments, you need to arrive at your taxable income to see whether your taxable income is crossing the threshold or it is falling under the qualifying income or not. Now we understood the terms natural persons and juridical persons. Now, who are natural persons? Natural persons as per UAE corporate tax law means an individual. So only individuals who engage in a business or business activity will be subject to UAE corporate tax. Individuals engaged in other activities will be outside the scope of corporate tax regime. UAE corporate tax will not apply if in case the individual is earning salary income, that is wages, if the individual is getting interest income or any other income from personal investment, savings income. This is outside the purview of UAE corporate tax. If the individual is getting dividends or capital gains from owning shares or any other income from owning shares or securities in their personal capacity, that is exempted. So dividends, capital gain on sale of shares, it is exempted. I'm talking about natural persons here. We'll come to the juridical persons and understand the implications about all these incomes there at a later slides. But here, if in case there is a natural person who is getting dividend income, who is getting salary income, of course, natural person gets salary income, who gets interest income, or if they get any income from the investment in UAE property, on that income, corporate tax is not applicable. For certain types of business activities, natural persons can form a sole proprietorship. So, friends, juridical persons doesn't include sole proprietorship in UAE. So, if you are running a sole proprietorship in UAE, the income from sole proprietorship needs to be taxed as if the income is earned by a natural person. And for the purpose of corporate tax, these entities will be treated as a natural person, and one corporate tax return you need to file whatever income you get either in your personal capacity or the income which you get from your business, sole proprietorship business. A single corporate tax return needs to be filed for that. Now, who are juridical persons? Juridical persons, as I've told you, is an entity which is registered or otherwise recognized under the laws of the regulations of the UAE or under the laws of a foreign jurisdiction. So the entity can be in UAE, will be categorized as juridical persons. The entity can be established, let's say in India. That entity will also be categorized as a juridical person. Examples could be LLC, that is limited liability corporation, could be foundation, could be onshore trust, public private joint stock company, etc. all the all the activities which are undertaken by a juridical person will be deemed as business activities and will be within the scope of UAE corporate tax unless specifically exempted. Now, UAE branches of a domestic or foreign juridical person. So let's say there is a branch, okay, in India, in UAE, and there is a foreign juridical person in US. So the branch will be regarded as a different juridical person, or it will be clubbed, or the profits of the branch will be clubbed in the parent company, is what we'll understand. UAE branches are regarded as an extension of their parent or head office and therefore are not considered as a separate juridical person. So that means there is a ALLC and there is a BLLC. Both are in UAE. BLLC is a branch of ALLC. So these two entities are not regarded as two juridical persons. BLLC will be regarded as part of ALLC as a branch. So no separate registrations required, no separate corporate tax filing is required for branches in the UAE. Whether foreign juridical persons are subject to UAE corporate tax? Yes, foreign juridical persons are subject to UAE corporate tax in the same way as a UAE resident person. If in case what? If in case there is effective management from UAE. If those entities are effectively managed and operated from UAE, even foreign juridical person will be taxed in the UAE as a UAE resident person. The next point is, when is a foreign juridical person considered as effectively managed? I said that, yeah, the company, the juridical person needs to be effectively managed and operated from UAE. But now the question arises, when is this foreign juridical person is considered as effectively managed and controlled from UAE? But the answer says, it depends on case-to-case basis. This needs to be assessed on a case-to-case basis and may look at the location where the key decision makers, such as the directors, make the strategic decisions affecting the juridical person. So it depends upon case to case. But yes, if you can prove, or the FTA proves, that the entity's effective operation is being carried out from the UAE, the foreign juridical person will be taxed in the UAE as a resident person. How are partnerships being taxed in UAE corporate tax? So under UAE, under UAE corporate tax law, partnerships are categorized in two forms. One is unincorporated partnerships. The second is incorporated partnerships. Now, if there is a partnership which is unincorporated, that means if there is a contractual relationship between two or more persons and they are doing some activity without registering themselves as a partnership. All right. So there is a contractual relationship between two or more persons, and these because of this contractual relationship, they are actually doing some business activity and earning income. So it is legal in UAE that you can do, two or more persons can come together and perform activities. So it's unincorporated partnership. For unincorporated partnership, whatever income they get respective partner has to offer the respective share of income in their individual corporate tax return. Because unincorporated partnerships are considered as transparent for UAE corporate tax purposes. So each partner is subject to UAE corporate tax on their respective share of income from the business which they conduct through the partnership. So natural persons that are engaged in a business or business activity through an unincorporated partnership are individually subject to UAE corporate tax. Meaning thereby, unincorporated partnerships are not considered as a separate legal entity, as a separate juridical person. Whatever income is earned by the unincorporated partnership, the individual partners has to arrive at their respective share and need to offer that income in their respective corporate tax return. Clear? Now, if in case there is a incorporated partnership, so incorporated partnership are categorized as a like a similar to juridical person, and they will be taxed as a separate legal entity. Now, is there an option for unincorporated partnership to go to the FTA? FTA stands for Federal Tax Authority. It is similar to Central Board of Direct Taxes in India. The FTA governs these provisions, and they are the authority which regulates, governs, monitors the the taxation of the various entities. Now, the unincorporated partnership is given an option that they can go to the FTA, apply to the FTA, and tell them that we would like to get taxed as a separate juridical person. If the application is accepted, the income of the unincorporated partnership will also be subject to UAE corporate tax as a juridical person in their respective capacity and not in the capacity of individual shareholders. Clear? Now, how are branches being taxed in UAE corporate tax law? So, UAE branches of a domestic or a foreign juridical person. Okay, so there is a branch in the UAE, okay, which is a branch of a foreign juridical person. They are categorized as an extension of their parent, which we have already discussed. Therefore, they will not be considered as a separate juridical persons. Now, income of the UAE branches of a UAE juridical person. So there is a UAE juridical person and there is a UAE branch. So the UAE branch income will be clubbed in UAE juridical person's income, and then the UAE juridical person will be taxed in the UAE by taking into consideration the income of the branch. So the branch will not be categorized as a different juridical person. The third category is the income of foreign branches or foreign permanent establishments of a UAE juridical person. So now there is a UAE juridical person, a juridical person which is situated in the UAE, and there is a branch outside the UAE. So that foreign branch income will be included in the taxable income, and the UAE corporate tax return of the UAE head office will be offered to corporate tax in the UAE, unless the UAE business elects to claim an exemption of its foreign branch profits. So if this already we have discussed. So what happens here is there is a entity in UAE and it has got a branch outside the UAE, let's say permanent establishment. So that branch income will also be clubbed in the corporate tax return of the UAE juridical person. However, there is an option given to the UAE juridical person to go and apply to the FTA, tell them that this branch is already taxed at a probably rate higher than or equivalent to 9% UAE corporate taxes. It is already being taxed in foreign. Please allow us not to include that income in my tax return. If FTA accepts, well and good, but there's a provision given in the law wherein you can opt for exemption of your foreign branch profits clubbing or inclusion in your UAE taxable income. Now, who are foreign persons? Will foreign companies and other juridical persons be subject to UAE corporate tax? So there are foreign companies and there are foreign juridical persons. Will that be subject to UAE corporate tax is the question. Yes, if foreign entities that operates in the UAE through a permanent establishment or that are considered as resident. So there are two categories. One is non-resident foreign juridical persons. The other one is resident juridical persons. So there is a juridical person which is incorporated outside the UAE but is effectively managed and operated from the UAE. That will be subject to UAE corporate tax. The other category is there is a corporate entity outside the UAE and which has got a permanent establishment in UAE will be taxed as a non-resident in UAE corporate tax. So when will a non-resident person be subject to corporate tax? A non-resident person will be subject to UAE corporate tax if the non-resident person has a PE in the United Arab Emirates. The income will generally be considered to be sourced from the UAE, where it is derived from a UAE resident or UAP. This we already discussed. Now, can a foreign company be subject to UAE corporate tax as a resident person? So here there is a foreign company. Can that be categorized as a resident person? Yes, if it is effectively managed and controlled in the UAE. So this already we have discussed, I believe. I have actually given all these provisions, tried to consider these, in a more detailed way, but I think we already discussed this. Now we will try to understand what is a permanent establishment in the UAE. A foreign person will have a permanent establishment if it has a fixed or permanent place in the UAE, all right, through which the business of the foreign person is carried out. That will be considered as a permanent establishment. Or if there is a person who has and habitually exercises an authority to conduct business, that means there is a person in UAE and you have a company in India, for example. There is a person in the UAE who is habitually exercising for your business, doing all the activities for your business. If it is proved that the person is exclusively working for you, in that case, it is termed as a permanent establishment in the UAE. A fixed place of business would not be considered as a PE if it is used solely to store. That means a warehouse, godown will not be considered as a permanent establishment. If there is a fixed place which is used solely to store, to display, to deliver goods or merchandise belonging to the foreign person, or to conduct any activities that are of a preparatory and auxiliary nature, will not be categorized as a permanent establishment. Preparatory auxiliary activities are those performed in preparation or in support of more substantive business activities. A PE would not arise if the person who is habitually exercising authority to conduct business on behalf of a foreign person as an independent agent. So the person who is habitually exercising must listen to the foreign person. He should not be an independent agent. If the person is an independent agent, can act independently, that will not be categorized as a permanent establishment. And where relevant, the application of international agreement, that is DTA, needs to be referred to when determining whether a PA permanent establishment exists or not. Now, what determines whether income is sourced from the UAE? We understood that if income is sourced from the UAE, that is taxable. Now, income will be considered to be sourced from the UAE if the income is derived from a UAE resident. If the income is derived, can be attributed to a permanent establishment in the UAE of a non-resident, or the income is derived from activities performed, assets located, capital invested, rights used, or services performed or benefited from the UAE. Corporate tax law includes a non-existent list of income that is considered as being sourced in the UAE. Now, what determines whether income is sourced from the UAE, right? Now, will UAE investment income earned by foreign investor, let's say there is someone in India who has got property in UAE, will that be taxed in UAE corporate tax? Income from dividends, capital gains, interest, royalties, and other investment returns earned by foreign juridical persons or individuals will not be subject to UAE corporate tax unless such income can be attributed to a permanent establishment. So in case of individual, there is no PE when you have a property in UAE, so you will not be attracted, the income tax will, the corporate tax will not be attracted on that income. Now we'll understand what is taxable income. We'll also try to understand what is standards to be used to prepare financial statements and whether financial statements needs to be prepared on accrual or cash basis. So taxable income for a tax period is nothing but the accounting net profit or loss duly adjusted as per the adjustments prescribed in the law. Now, what are the standards to be used to prepare financial statements? In UAE corporate tax law says that the financial statements of UAE entities and other businesses should be prepared in accordance with accounting standards accepted in the UAE. And IFRS is the most frequently used accounting standard. So your entity, if you have an entity, you need to follow IFRS in order to arrive at the accounting profit or loss. And then with that accounting profit or loss, you need to perform your adjustments and arrive at the taxable income. Now, whether while preparing financial statements, can you follow cash system, or is it like you need to follow only accrual basis of accounting? Generally, the law says you need to follow accrual basis of accounting. However, you can again go to the FTA and seek a permission that you want to follow cash system of accounting. And if in case FTA approves, you can follow cash system. But generally, you need to follow accrual system of accounting system while preparing your financial statements. United Arab Emirates corporate tax adjustments to the financial statements that will be required to calculate taxable income. So what are those adjustments? We already discussed unrealized gains or losses you need to adjust, exempt income, intragroup transfers, deductions. These adjustments you need to perform in order to arrive at the taxable income. So what is the corporate tax treatment for any unrealized gains and losses arising from accounting fair value or impairment adjustments? Right? We all know that we arrive, a lot of companies, in fact, majority of the companies, as per IFRS, have to follow impairment of losses adjustment. Now, if in case the company is following impairment of losses, and if there is any unrealized gain and losses, will that unrealized gain and loss be allowed while arriving at the taxable income? So there are basically two options given in the law. Option one says the taxpayer can elect to recognize gains and losses on a realization basis. That means when the asset is sold, only then whatever losses or gains you get, you need to realize at that particular time. So option number one says for all the assets and liabilities, you can elect to recognize your gain or losses on realization basis. The second option is not for all the assets, but only for assets and liabilities held on capital account. That means only for the balance sheet assets and liabilities, that is long-term liabilities or fixed assets. You can go for realization principle, and then you need to accordingly adjust your taxable profit by disregarding unrealized gains and losses and making corresponding adjustment to your taxable income. Now, what is the realization principle and when is income realized for UAE corporate tax purpose? Many other corporate tax systems, similar to other corporate tax systems in UAE, the corporate tax regime allows taxpayers to apply the realization principle for determining the taxable income. That means the income will only be taxable and the deduction would only be able to be taken if and only if when the gain or loss is realized. So this is the realization principle. Now, what are exempt incomes? Exempt incomes we already discussed. We'll try to again understand it here. Dividends and other profit distributions received from entities incorporated in the UAE. All the dividends which you receive from entities incorporated in the UAE are exempted. There can be an instance where you are getting income in the form of dividends from entities outside the UAE. So if there is a juridical person which is outside the UAE, if it fits into the definition of participation interest. What is participation interest? That means the shareholder is owning 5% or more of the share capital of that company. So if that company is a participating interest, whatever dividend the UAE company or the UAE natural person is getting from that participating interest is exempted. Then capital gains, foreign exchange losses from a participating interest is exempted. Income from a foreign branch or a PE where an election is made to claim the foreign PE exemption, that will be exempted. Income earned by non-residents from operating or leasing of aircraft or ships in international transportation where certain conditions are met. So if there is a non-resident who is operating or leasing aircraft or ship, that income is also exempted in UAE under UAE corporate tax law. Now, what are exempt incomes? If in case are all dividends and other profit distributions earned exempted from UAE corporate tax? The question here is, there are two questions I have highlighted. One is dividends and other profit distributions earned by UAE juridical persons. Are they exempt? The answer is yes. Domestic dividends and other profit distributions earned from UAE juridical persons are exempt. Irrespective of the level of ownership, you can hold 1%, you can hold 0.1% of the share capital. Whatever dividend you get from UAE juridical person is exempted. This exemption is also applicable to dividends received from a UAE juridical person that benefits from a corporate tax exemption or where profits are subject to 0% tax. So irrespective of your nature of entity, if the entity is a UAE juridical person, dividends received from that UAE juridical person is exempted. Now, whether all dividends and other profit distributions from foreign juridical persons exempt, answer is no, not all the dividends. Only when you get a dividend or other profit distribution from a participation exemption. Participation entity, I have told you, is an entity wherein your investment is more than or 5% in the share capital. So if the participating interest is a 5% or greater ownership interest in the capital or equity of the foreign juridical person, that meets the conditions of the participation exemption. Only in those cases where you're getting dividend from participating interest, there the dividend, whatever you get, is an exempt. Now, what is exempt income in terms of capital gains? So whether capital gains exempt, under the participation exemption, if you get any capital gain, that is exempted. Other than participation exemption capital gain, whatever capital gain one gets in UAE is taxable. So apart from what you are getting, if in case you are getting capital gains from an ordinary activity, is an ordinary income, right? Then it is taxable. But capital gain from participation exemption is fully exempted. Participation exemption we discussed. It is basically where a juridical person in which UAE shareholder company owns a 5% or greater ownership. Now, can I benefit from UAE corporate tax exemption if I own less than 5%? The answer is no. Let us try to understand deductions concept. Against your accounting profit, I have told you that you need to perform adjustments as regards deductions. Not all the deductions which you incur from your business are allowed as a deduction. There can be certain deductions wherein partially the deduction is allowed. There can be a deduction wherein 100% deduction is allowed. There can be a deduction where nothing is allowed. Entire amount will be disallowed. So let us understand those. So let us understand what expenditure will be deductible for the purpose of calculating taxable income and what expenditure will be non-deductible. All legitimate business expenses incurred to derive taxable income will be deductible. So if in case you are incurring expenditure in order to earn income or for the purpose of business, that will be allowed as a deduction. For capital assets, expenditure would generally be recognized by way of depreciation. So depreciation is allowed. Expenditure which has a dual purpose, such as expenses incurred for both personal as well as business purpose, that needs to be apportioned with the relevant portion of the expenditure treated as incurred wholly and exclusively for the purpose of taxable person business. So you need to apportion the dual purpose expenditure if in case you are incurring expenditure for both personal and business. Are there any deductions where 100% is disallowed? Yes. If in case you pay bribe, the expenditure is disallowed. If in case you are incurring expenditure towards fines and penalties, totally disallowed. If you are incurring expenditure to arrive exempt income, disallowed. If you have losses that are not connected with or arising out of your business, that is disallowed. Additionally, certain restrictions may also apply to the deduction of interest expenditure. Under UAE corporate tax law, interest is not fully allowed as a deduction. There is a concept called as, I'll explain you here, whether interest is expenditure, whether fully deductible or not. So there is a concept called uh, wherein 30% of your interest only is allowed. It's called as basically uh, wherein what happens here is the capital in the company is purposefully kept at a very lower side, and the debt amount in the company is at a very higher side. Because of this, what happens is whatever interest, even though the company is into losses, the fixed amount of interest goes out of the company. So if 100% deduction is allowed, the company will be into losses, right? So the corporate tax law provides for certain restrictions on the deductibility of interest expenditure to discourage excessive debt financing and to ensure that debt financing used or arising as a result of certain specific intra-group transactions will only be deductible if there is a valid commercial reason. So there are two limitation rules prescribed in the law. One is general interest deduction limitation rule. The another one is specific interest deduction limitation rule. Now, what this general interest deduction limitation rule says, if there is a business and there is a net interest expenditure in that. And what is net interest expenditure? Your interest expenditure minus interest income. So businesses where there is an interest expenditure, the interest expenditure will be restricted to the 30% of your EBITDA. EBITDA is nothing but earnings before interest, tax, depreciation, and amortization, excluding any exempt income. So any net interest expenditure which exceeds the limit may be carried forward and utilized in the subsequent 10 tax periods. So let's say EBITDA is 100,000 and your net interest expenditure is 40,000. So up to 30,000 net interest expenditure will be allowed in this year. The remaining 10,000 will be carried forward and will be allowed to be set off against future income. Okay, so now businesses with net interest expenditure below the threshold to be set out. If in case the interest expenditure is nominal or negligible, the ministry may come up stating that up to certain amount of interest expenditure, you can still claim 100% deduction. But that limit is not set as on date. But ministry may come up or the cabinet decision may come up at a later stage wherein they can give this value. As on date, the law says up to 30% of your net, up to 30% of your EBITDA is allowed as an interest deduction. Now, there is one more concept called specific interest deduction limitation rule, which says where a loan is obtained from a related party and is used to finance income which is exempt from corporate tax. That means a loan is obtained from a related party and is used to pay dividends or to distribute profits. Here, what is happening? The loan is availed by the company, and in turn, the profit is distributed, which is exempted from tax. Such kind of loans and such kind of interest will be disallowed. The loan is, of course, permissible, but interest which you pay for obtaining this kind of loan will be disallowed. The interest on the related party loan will not be deductible unless the taxpayer can demonstrate that the main purpose of obtaining the loan and carrying out the transaction is to not gain a corporate tax advantage. So as regards interest deduction, there are two rules which we need to look into: whether the loan was obtained from a related party and the purpose for which the loan is obtained. And the other one is, if in case it is not from the related party, then 30% of the EBITDA is allowed as a deduction. Now, there can be certain expenditure in the nature of entertainment expenditure. So whether these expenditure is fully deductible, the law says we understand that businesses have to incur expenditure which is in the nature of entertainment expenditure, but we will not give you 100% of the deduction as a deductible expenditure. So 50% of your deduction or the expenditure will be allowed as your deduction. What are those kind of entertainment expenses? Let's say you're providing meals to your staff, you're providing accommodation, transportation, admission fees. So that you can, this kind of entertainment expenses you might incur for your customers, for your shareholders, for your suppliers or other business partners. Of course, employees are not considered here, only customers, shareholders, suppliers, and other business partners. So if you're incurring any expenditure which is in the nature of entertainment, then 50% of such expenditure will be disallowed while arriving at your taxable income. Now, when there are, it's quite common practice across the world to transact with your related parties. One sister concern is transacting with another one. The transaction between holding company and subsidiary companies. So what happens in order to make sure that the transactions are happening at an arm's length price or not? The law, respective countries comes up with the law provisions wherein they say that any transaction between the related parties needs to be at the arm's length price. So there are certain transfer pricing provisions which is prescribed in UAE Corporate Tax Law as well, which needs to be adhered to. It says it seeks to ensure, the transfer pricing rules seeks to ensure that the transactions between related parties are carried out at arm's length price, as if the transaction was carried on between independent parties. To prevent the manipulation of taxable income, various articles in the corporate tax law require that the consideration of transactions with related parties and connected persons needs to be determined by reference to their market value. So let's say if I'm transacting with my sister concern, I have sold a property for 100,000 and I'm selling the similar property for 500,000 to my customer. So here the transaction between me and my related party is not at arm's length price, it's not at the market value. The law says you need to arrive the transaction value of this particular transaction as well by considering the transaction price, by considering the transfer pricing regulations, and you need to arrive at the market value of this transaction as well. Will transfer pricing rules apply to both domestic and cross-border transactions? The answer is yes. When you transact with your domestic connected persons or related parties, or if you can transact with cross-border transactions, if you perform with your related parties, you need to adhere to transfer pricing rules. Now, who are related parties and who are connected persons? The law has defined related parties as regards individual as two or more natural persons will be regarded as related parties if they are related within the fourth degree of kinship or affiliation, including by way of adoption or guardianship. If in case individual together with the related parties owns the controlling ownership interest of 50% or more, then they'll be treated as a related party. So that means I am a shareholder and my relative, we both collectively hold 50% or more share capital in a company, then the company and me will be considered as a related party. Now, as regards related parties of a company, any companies in which the company alone or together with the related parties has a controlling ownership interest of 50% or more, then those two companies will be considered as related parties. Now, who are connected persons? So, with respect to juridical persons, connected persons are the owner of the business, the director or officer of the business, or a related party of either of the above. So, these will be considered as connected persons. So, when a transaction happens between connected persons, the owner of the business, right? The owner of the business, let's say I'm paying, there is a director or officer of the business, there is a director, I'm paying remuneration, which is not matching with the industry standard. I'm paying director remuneration of 1 million dirhams, wherein the industry for the similar business is paying only 100,000 dirham. So when I'm transacting with my connected person, the I'm excessively booking the remuneration. So what I need to do is I need to arrive at the market value. What is the industry standard? These all things we need to take into consideration. So that is what the transfer pricing guidelines says. When you transact with connected persons, when you transact with related parties, you need to take into consideration the transfer pricing rules. Now, what are the various transfer pricing methodologies? I think we all know there are a lot of methods where from you can arrive at the transfer pricing transaction value. There can be a system which you can adopt this comparable uncontrolled price method. There's a method called resale price method, RPM, cost plus method, transactional net margin method, transactional profit split method. So these are various mechanisms, transfer pricing methodologies the company can adopt based on case to case, based on the transactions which they have, and then they need to justify that yes, for this transaction, this is the value they are arriving it by following so and so methodology. What documentation should be maintained in respect of transfer pricing? Businesses has to maintain information regarding the transactions with related parties and connected persons. They also have to be required to submit this information along with the tax return. Businesses that claim small business relief, as I've told you, if it's a juridical person up to 83 million dirhams, you can claim benefit under small business relief. Or if you are a natural person, of course, transfer pricing regulations are not applicable to natural persons here. So if you are a business, if you are taking relief under small business relief, then in that case, transfer pricing regulations are not applicable to you. Now, certain businesses may also have to maintain master file and local file. Now, let us see if in case there is a loss in an entity, how that needs to be considered. So can you carry forward the loss which you have in your company and set off against future profits? The law says yes. Up to 75% of your taxable income, you can adjust your carried forward losses. The tax losses can be set off against the taxable income of future periods up to a maximum of 75% of the taxable income. So I have a loss of 100,000, all right, and I have a profit in next year of 150,000 dirhams. Can I offset the entire 1 lakh against 1,50,000? 150,000 is the question. I cannot set off the entire loss against my 150,000 dirham profit of the next year. only to the extent of 75,000 dirham, that is to the extent of 75% of my loss. Pardon me, up to the 75% of the taxable income. So let's say my taxable income in this case is 100,000, and I have a carried forward loss of 100,000 dirham. I can transfer up to 75%. I can set off the loss up to 75% of my taxable income. So 25,000 will remain my taxable income. The remaining 25,000 will get it carried forward to the next year. And is there a restriction like for 5 years, 10 years, 15 years, for how many years I can carry forward? There is no restriction as such. I can carry forward my loss indefinitely, provided the second condition. It says I can carry forward without limitation, provided the same person or persons continue to own at least 70% of the entity with the losses. And where there is a greater than 50% change in ownership, tax losses may still be carried forward provided there is no major change in the nature or conduct of the entity's business. Right? So you can carry forward provided there should not be change of ownership. Even if there is a change of ownership beyond 50%, if you can prove that the nature of the business is still the same, you can still carry forward your loss. Now, transfer of tax loss in a group company. In UAE, it is quite common to have more than one companies by one individual. So it's a quite it's a fashion in UAE where one has multiple companies. So can I offset my loss of one entity with the profit of another entity? The law says yes, you can offset. Again, there is a restriction, there is a cap to it. Up to 75% is what you can offset. So the tax losses from one UAE group company may be used to offset taxable income of another UAE group company where there is a common ownership of 75% or more, and no tax loss transfers will be allowed from companies that are exempt or that are benefit from 0% corporate tax regime. So the condition says when you can transfer where both these companies are UAE resident juridical persons, when either company holds 75% or more of the share capital of the other company, neither company is an exempt company, neither company is a qualifying free zone company, and the financial statements must be prepared using the same accounting standards. So if all these conditions are satisfied, then the tax loss of one entity can be adjusted against the tax loss of against the profit of other entity. Now, tax credit. So there are two forms of tax credit. One is withholding tax and the other is foreign tax credit. As on date, under UAE corporate tax law, 0% withholding tax is applicable to certain types of UAE sourced income paid to non-residents. And because of 0% tax rate, no withholding tax would be due. There will be no withholding tax related registration and filing obligations for UAE business. So no TDS returns, no TCS returns as on date because the rate prescribed in the law is 0%. And withholding tax does not apply to transactions between UAE resident persons. So the withholding taxes are applicable only when there is a UAE sourced income which is paid to non-residents. When you are paying to UAE resident persons, no withholding taxes applicable. Foreign tax credit, FTC paid on income that is also subject to UAE corporate tax can be deducted similar to the what we have in India to the extent of your liability. Foreign tax credit, whatever you are paying, you can claim credit of that while filing your corporate tax return. Maximum foreign tax credit is the lower of the foreign tax paid and the UAE corporate tax payable on the relevant income. Any excess FTC cannot be carried forward. Free zone concept. So we'll try to understand now free zone concept, which is quite famous in United Arab Emirates. There are a lot of entities which are formed in free zones in United Arab Emirates. Let us try to understand the concept of free zone first. The concept of free zone enterprises was introduced to protect the interest of business owners who wanted to use UAE as a trading hub. A lot of companies are there in UAE which acts as a trading hub in UAE, wherein they purchase goods, they purchase cargoes, and in turn supplies to, because UAE is considered as the starting point of the Middle East. So they in turn supply this cargo to various parts of MENA region, Middle East, North Asia region. So in order to form companies in UAE free trade zone, UAE has encouraged people to come forward, have their companies in free zone, wherein they will not levy any taxes. taxes in the sense both indirect taxes, VAT, and as well as direct taxes, corporate tax. So the assurance was given by the UAE government to the companies formed in UAE free zones that there will not be any taxes. So with that assurance, keeping that in mind, in the UAE corporate tax law also, there are a few provisions which says that if the entities are in free zones, if they are considered as a qualifying free zone, earns income from qualifying activities, they will not be subject to corporate tax. So free zones was introduced, the concept of free zones was introduced to protect the interest of business owners who wanted to use UAE as a trading hub. Free trade zone is a secluded area. It's basically a different area which is properly fenced. Goods that are imported into the free trade zone are brought in without payment of custom duty. You can export from free trade zone without even paying taxes in UAE. If the goods are moved from the free zone into mainland, then it would attract customs duty. The business activity that can be performed by the free zone entity is decided by the respective free trade zone authority. Free zone enterprises do not generally have any trade ties with the mainland, and hence the requirement of having a UAE national. If you have a company in mainland, then you need to have a local person, local Emirati person as your partner, and 51% of your shareholding will belong to that particular national, Emirati national. But if you have a company in free zone, you can become a 100% owner of your company. There are few free zones which I have highlighted here, which is spread across various emirates. In Ajman, you'll find Ajman free zone. In Abu Dhabi, you'll find free trade zone of Khalifa Port. In Dubai, you'll find IFZA, International Free Zone Authority. Dubai Airport free zone. In Sharjah, there is Hamriya free zone. So you'll find around 50, more than 50 free zones in UAE where you can go and form your company. And the taxation of free zones are different with the taxation from the regular juridical persons which are incorporated in mainland. So who is a free zone person? A free zone person is a legal entity that is incorporated or established under the rules and regulations of a free zone, or a branch of a mainland UAE that is registered in a free zone, or a branch of a foreign legal entity which is registered in a free zone. So free zone persons, are those entities which is incorporated in the UAE. And what is the free zone corporate tax regime? Free zone corporate tax regime is a form of UAE corporate tax relief which enables free zone companies and branches that meet certain conditions. So these free zone entities, they have to meet certain conditions in order to benefit from a preferential 0% corporate tax rate on their income from qualifying activities and transactions. So what we need to understand is what is free zone, who are free zone persons, and what are qualifying free zone persons. So only the income of a qualifying free zone person are subject to tax at a preferential rate of 0%. If it is not a qualifying free zone person, then the non-qualifying free zone person will be taxed similar to other entities, that is up to 375,000 9%, and over and above up to 375,000 0%, over and above 375,000 9%. But if the entity is considered as a qualifying free zone person, they are taxed at a preferential rate of 0%. Natural persons, unincorporated partnerships, sole establishments cannot take the benefit from the free zone corporate tax regime. Why has UAE introduced a free zone corporate tax regime? See, in recognition, as I've told you, UAE has given an assurance, the government has given assurance to the people when they were forming company in free zone that they will not levy any taxes on that. So in recognition of the continued importance and the tax related commitments that were made at the time free zones were established, free zone companies and branches that meet certain conditions can continue to benefit from 0% corporate tax on income from qualifying activities and transactions. What are qualifying activities? What are qualifying transactions? We'll understand here. Now, who is a qualifying free zone person? A qualifying free zone person is a free zone person that meets all the conditions of the free zone corporate tax regime and hence benefits from that regime. The conditions are they need to maintain adequate substance in a free zone. Now, what is adequate substance? They should have adequate assets, they should have adequate manpower, they should incur adequate operating expenditure. Then only it will be considered as having adequate substance in the free zone. It should not be a namesake company primarily. They should also derive income which falls under qualifying income category. They should not have made an election to the FTA to get taxed under the regular regime. So even if it's a qualifying free zone person, they have an option to go to the FTA and get themselves, apply to the FTA and ask them to get taxed at regular tax rates, that is up to 375,000 0% or and above 375,000 9%. So if they do not make an election to the FTA that they do not want to consider themselves as a regular person, then this condition has to be satisfied. They have to comply with transfer pricing guidelines, regulations, and methodologies, and they also have to prepare and maintain audited financial statements. If the free zone satisfies all these conditions, they'll be considered as qualifying free zone person. A qualifying free zone person must have adequate staff, they must have adequate assets, and incur adequate operating expenditure in a free zone in order to categorize themselves as a qualifying free zone person. Failure to meet any of the conditions results in a qualifying free zone person losing its qualifying status and not being able to benefit from the free zone corporate tax regime for 5 tax periods. So if any of the conditions fails, the free zone will not be considered as a qualifying free zone, and that non-qualification will stand good for 5 tax periods. Is there any minimum investment or employment requirements? I have told you that adequate substance is what is required as one of the conditions. Will there be a minimum investment that I need to invest 1 million dirham, or is there any minimum employment requirement in order to benefit from the free zone corporate tax regime? Answer is no. There is no minimum investment required. There is no minimum number of employees that you need to have 2 employees or 10 employees. That is not prescribed. The law says that you need to have adequate substance, right? So the free zone corporate tax regime does not prescribe any minimum investment, job creation, or business expansion requirements. However, qualifying free zone must have an adequate staff and assets and must incur adequate operating expenditure in a free zone relative to the qualifying income it earns. So there should not be like, earning in billions and millions and not having expenditure. So you must incur expenditure relative to the qualifying income which you are earning. A qualifying free zone person can outsource its activities to related or unrelated persons in free zone. It is allowed, provided it exercises control and supervision over the outsourced activities. Now, what constitutes adequate substance again depends on the particular circumstances, will need to be assessed on a case-to-case basis. What is a qualifying income? Qualifying income is the income that can benefit from the corporate 0% preferential rate of corporate tax rate. I've told you that there has to be a qualifying free zone person, and 0% rate is applicable on the qualifying income earned by qualifying free zone person. So qualifying income is the income on which 0% corporate tax rate is applicable. It includes income derived from transactions with other free zone persons, as well as domestic and foreign sourced income from any of the qualifying activities. So what is qualifying income? Income derived from transactions with free zone persons and income derived from qualifying activities. So what is qualifying activity? Is prescribed in Ministerial Decision number 139. So qualifying income does not include income derived from performing any of the excluded activities. So this Ministerial Decision number 139 prescribes activities, divides activities into 2 categories. One is qualifying activities, the other is excluded activities. So if there is an excluded activities, of course that will not be categorized as a qualifying activities, and then the income earned from excluded activities will not be a qualifying income. So what is qualifying activity or qualifying income? All income derived from transactions with free zone persons is treated as qualifying income, unless the other free zone person is not the beneficial recipient of the relevant transaction. That means if you're transacting with other free zone person, it will be termed as a qualifying activity or the qualifying transaction. However, the other free zone person should be the beneficial recipient of the relevant transaction. Or if you are getting an income which is derived from other than excluded activity, that is from your qualifying activity, the income will be considered as a qualifying income. Now, income derived from another free zone person that is not derived from an excluded activity will be treated as qualifying income, irrespective of the fact whether that other free zone person can benefit from the free zone corporate tax regime or not. That means there is an A free zone and B free zone. D free zone is not opting for a special rate of 0%, not considering itself as a qualifying free zone person. But that being a free zone person, if you're transacting with a free zone person, and that free zone person is actually the beneficial recipient of the transaction, the income you get will fall under qualifying income. A free zone person is the beneficial recipient of a transaction where the other free zone person has a right to use and enjoy the supply. In that case, the free zone person will be categorized as the beneficial recipient. Free zone persons acting as an intermediary, agent, or conduit on behalf of another person would not be considered as beneficial recipient. Now, what are excluded activities? Excluded activities are activities that would disqualify a qualifying free zone person from the free zone corporate tax regime, irrespective of whether those activities are performed exclusively within the free zone or regardless of the fact whether the related income is derived from transactions with free zone person. That means a free zone person, a qualifying free zone person, if earning income from excluded activities. So whether you are earning from free zone person, whether you are earning within the free zone, despite of all these facts, if the income is from excluded activities, that will be considered as non-qualifying income only. Now, Ministerial Decision number 139 has prescribed certain activities as qualifying activities and excluded activities. Now, here I have highlighted few excluded activities which is defined by the Ministerial Decision. Transactions with natural persons. If you're transacting with natural person, it is an excluded activity. However, there is an exception to it. If you're transacting with natural person in relation to ownership, management, and operation of ships, that is considered as qualifying activity. If you're transacting with natural persons in respect of fund management services, wealth investment management services, regulatory oversight should be there, and financing and leasing of aircraft will be considered as a what excluded activity when you are transacting with natural persons. However, these activities are not considered here. So all the transactions with natural persons are excluded activities. If in case you have an activity of ownership, management, and operation of ship, even if you transact with natural person, that will not be considered as excluded activities. Now, regulated banking activities, regulated insurance activities, these are also will be categorized as excluded activities. If you are a ownership, if you have a ownership or exploitation of intellectual property rights, royalty income, patent income, if you're getting anything considered as excluded activity, any income you get on it, you need to pay tax at the rate of 9%, and not, you will not get a special privilege of getting taxed at 0%. So these are few activities which I wanted to share with you. However, there is one rule which is called as de minimis rule. What de minimis rule says, if you have qualifying income and if you have non-qualifying income, that is income from excluded activities. But if that non-qualifying income is 5% or less of your total revenue, then even income from non-qualifying activities or non-qualifying income will be given a special privilege and the tax has to be paid at 0%. So de minimis rule says 5% is negligible. Okay, you are earning 95% income from your qualifying activities. You're getting qualifying income. Let us ignore 5% and entire revenue we will tax you at 0%. So this is what the de minimis rules says. What are qualifying activities? These are activities that can benefit from the free zone corporate tax regime, regardless of the fact whether the income is derived from transactions with another free zone person, a person in the mainland or from free. So if in case you are having a qualifying activity, if you are into qualifying activity, whether you are getting income from free zone, from mainland, from foreign, the income which you earn from qualifying activity as prescribed in Ministerial Decision 139, it will be categorized as qualifying income. So these are various qualifying activities. If you get any income, if you transact into this qualifying activity, will be categorized as qualifying income, will be subject to 0% corporate tax. All right, what are those activities? Manufacturing, processing, holding of shares, ownership. So these are various activities. We will not deep dive into this because time is pressing. So Managerial Decision 139 has come up with two kinds of activities. One is excluded and one is qualifying activities. Now, are transactions with UAE domestic persons treated differently to transactions with foreign persons? No, because if you transact with UAE mainland, whether you transact with foreign persons, the transactions are treated alike. You know, the transactions with the mainland, the transactions with the foreign persons are treated the same under the free zone corporate tax regime. What is the relevance of being located in the designated zone? If you are in a designated zone, a qualifying free zone persons which is established in a designated zone can earn qualifying income from the wholesale distribution as well. So in order to avail that preferential tax rate of 0%, if in case you are in a distribution business, in that case, you need to be in a designated zone in the UAE. A qualifying free zone person that is established in a free zone that is not a designated zone, on the other hand, can only earn qualifying income from the sale of goods and materials to other free zone persons. So if you are in a designated zone, whether you are selling to domestic people, whether you are selling to free zone person, whether you are selling to persons located outside the UAE, entire revenue is qualifying income. But if you're not a designated zone, only when you supply to other free zone persons, then only that will be considered as qualifying income. If you supply to any person in mainland, if you supply to any person in foreign, then that will not be considered as qualifying activity. Now, how are qualifying free zone persons taxed? They are subject to tax at a 0% corporate tax rate on the taxable income from qualifying activities. So there is a qualifying free zone person which is subject to tax at 0% from their qualifying activities. If they have non-qualifying activities, income from non-qualifying activities will be subject to tax at 9%. Now, certain income from immovable property in a free zone is also subject to 9% corporate tax. So there is an immovable property in free zone and it is in commercial nature. Now, this applies to income from transactions with non-free zone person in respect of commercial property and to income derived from residential units. Now, certain income from immovable property in a free zone is also subject to 9% corporate tax rate. So, normally, income from immovable property, whether it is a commercial or it is non-commercial, is what we need to look at it. If it is a commercial property and if the income is getting from a free zone, then that is subject to 0% tax. But if the commercial property, if it is a non-commercial property, the income derived from residential units or hotels, that is subject to 9% corporate tax rate. All right. Now, what happens if a qualifying free zone person earns income which is not a qualifying income? They have to pay tax at the rate of 9%, subject to de minimis requirements. And what are de minimis requirements? It says under the de minimis requirements, a qualifying free zone person can continue to benefit from the free zone corporate tax regime where its revenues from non-qualifying transactions and activities do not exceed 5% or 5 million dirham. So up to 5% is allowed or 5 million dirham is fine. Beyond this, if there is a non-qualifying income, then the qualifying free zone has to pay tax at 9%. Up to 5% or 85 million is fine. If in case there is an income which is a non-qualifying income and which is less than 5 million dirham or 5% of total revenue, whichever is less, on the entire revenue, 0% corporate tax is what the qualifying free zone person has to pay. Next question is, can a qualifying free zone person benefit from 375,000 dirham? I have told you that the regular persons are taxed. Up to 375,000, there will not be any tax, and beyond 375,000, 9%. Qualifying free zone person on qualifying income, 0%, non-qualifying income, 9%, right? So there is a free zone which has got 100,000, let's say, which has got 100,000 dirham as income from non-qualifying activity and 200,000 dirham as income from qualifying activities. So on income from qualifying activities on 200,000 dirham, the qualifying free zone person has to pay tax at 0%. On non-qualifying activities, that is 100,000, they have to pay 9%. But can they claim the benefit of 375,000 dirham while arriving at the tax portion of the 100,000 non-qualifying activity? The answer is no. Qualifying free zone person, if again, qualifying free zone person has an option to go to the FTA, tell them that we do not want to fit into the definition of qualifying free zone person and want to pay tax normally. In that case, fine. But you cannot take the advantage of both the provisions. You cannot act as qualifying free zone person and also take advantage of 375,000 dirham. That is not allowed. So free zone person that is not a qualifying free zone person will be able to benefit because they are going to the FTA telling that we do not want to categorize ourselves, consider ourselves as a qualifying free zone person, tax us at a normal rate. In that case, up to 375,000, no taxes. Over and above 375,000, tax at 9%. But if in case QFCP, the free zone person, considers themselves as a qualifying free zone person, then 375,000 limit is not applicable. Whatever income they get over and above their qualifying income, if it is in the nature of non-qualifying income, they have to pay tax at 9%. Clear? How is a domestic or foreign PE of a free zone determined? Similar to mainland provisions. So we'll skip this as time is pressing. How do you determine the income of a domestic PE? Okay, fine. Let us try to understand few other key provisions of free zones. Now, qualifying free zone persons cannot be a member of a tax group. There is a concept in law, we will understand here. What is a tax group? So they cannot become a member of a tax group. They cannot be part of a qualifying group. They cannot transfer or receive tax losses. They cannot claim small business relief. So these special privileges are not available to qualifying free zone persons. All free zone persons will be required to obtain a tax registration number and file a corporate tax return, irrespective of the fact whether they are a qualifying free zone person or not. So if you are an entity registered in free zone, you need to obtain a TRN, you need to register yourself, you need to file your tax returns, whether you have income or not, whether you have losses or not, whether you are a qualifying free zone person or not. So irrespective of the fact, if you are a free zone entity, you need to comply with all these compliances. The qualifying free zone person will be required to register and file a single UAE corporate tax return, reporting both its qualifying income and the taxable income, which is attributable to both domestic or foreign PE. There is no requirement for the domestic or foreign PE to separately register and file a UAE corporate tax return with the FTA. So single UAE corporate tax return is what the free zone has to file with the Federal Tax Authority. Now, let's say there's a qualified free zone person in UAE and which has got a domestic PE in mainland or a foreign PE. So, will a domestic or foreign PE be required to register and file a separate UAE corporate tax return? No, they do not have to register separately. The qualifying free zone person will be required to register and file a single UAE corporate tax return, reporting its qualifying income and the taxable income that is attributable to its domestic or foreign PE as well. So there is no requirement for the domestic or foreign PE to separately register and file UAE corporate tax return with the FTA. So this is a case where a qualifying free zone person has a domestic or a foreign PE. Now let us understand a different scenario here. There is a free zone. In the free zone, there is a branch of a mainland or foreign juridical person. So whether this branch has to get registered, has to comply with the law, we already learned that branches need not have to register separately. The mainland juridical person or foreign juridical person has to comply with the law, has to get registered, file taxes, duly incorporating the profits and incomes of this branch, which is there in the free zone. Now, sector specific, let us try to understand whether few sectors, banking sectors are covered or insurance sectors are covered or not. So businesses engaged in the extraction of the UAE's natural resources and in the non-extractive aspect of the natural resources value chain that are subject to emirate level taxation will be outside the scope of the UAE corporate tax regime, because the taxes are being levied at emirate level, at respective emirate level. So these incomes, if these businesses are kept outside the scope of UAE corporate tax law. UAE headquartered banks and UAE branches of foreign banks will be subject to UAE corporate tax. So banks are covered. Businesses engaged in real estate management, in construction, development, agency and brokerage activities will be subject to UAE corporate tax. So they are also covered here. Asset management, broader financial service sectors will be subject to UAE corporate tax, although investment funds that meet certain conditions can apply to be exempt from UAE corporate tax. So asset management companies are also covered. Further, under the so-called investment manager exemption, UAE-based and regulated fund managers and other investment managers can perform discretionary asset or investment management services without creating a taxable presence. Now, charities and other public benefit organizations are, whatever receipts they get, they are outside the scope of UAE corporate tax. They are considered as exempt. Income earned by foreign operators of aircrafts, ships, that is non-residents, which are into international transportation, operation of aircraft, ships, they are exempted from UAE corporate tax. This exemption would only apply where the country of foreign airline or shipping company would grant a similar exemption to UAE operators of aircrafts and ships. Now, let us try to understand the concept of tax groups in UAE. As I've told you, in UAE, it's quite fashion to have multiple companies, or there can be a holding company and subsidiary companies in UAE. So, can they form a tax group and comply with the law as a single entity? The answer is yes, subject to these conditions. And what are those? UAE companies can apply to form a tax group, be treated as a single taxable person. So there are multiple entities, will be treated as a single taxable person for the purpose of compliances of UAE corporate tax law. When the UAE parent company, there is a parent company in UAE which directly or indirectly holds at least 95% of the share capital of each of the companies. So in an example, there is a company A which owns 20% of the share capital of company B. And the company A owns 100% of the share capital of company C. Company C in turn holds 80% of the share capital of company B here. So here company A directly or indirectly is holding 100% shares of company B as well. So these three entities can come together and form a tax group, can apply to the FTA, tell them that we would like to get taxed as a tax group. We do not want to comply with the law individually. We want to comply with the law by considering ourselves as a single entity. The law says yes, you can do so because you are complying with the and satisfying the conditions prescribed in the law. To form a tax group, neither the parent company nor any of the subsidiaries can be an exempt person. So all these company A, B, C, they should not be an exempt person, they should not be a free zone entity, they should be a taxable person. All companies must use the same financial year and prepare their financial statements using the same accounting standards. So they need to follow these additional conditions as well, that the entities which they want to bring into the tax group should not be an exempt entity, should not be a free zone entity. They should follow the same accounting standard. They should follow the same financial statements and same financial year. All right. So once they comply with these conditions, they can go to the FTA and form a tax group and pay taxes collectively rather than paying and complying with the law individually. UAE subsidiaries of a foreign parent company can form a tax group. However, the foreign parent company must have a PE in India, so they can form a tax group. The foreign entities can also be included in tax group, provided the foreign entities manage and control in the UAE. Now, 0% threshold limit of 375,000 is there, right? So, if in case they do not form a tax group, individually they can benefit from this 375,000 threshold. But if they form a tax group, in order to in order to comply with the law with ease, why to have so much compliances when they have entities which are all almost like holding subsidiary? They do not want to go and comply separately. They form a tax group and then comply at a single level, at a parent level. Now the 375,000 threshold will apply to the tax group. It is not like you have three companies, you will be given 375,000 threshold into 3 times as a basic exemption limit or 0% tax rate benefit you will get for each entities. For the group as a whole, the benefit of 375,000 dirhams, 0% tax rate you will get, irrespective of the number of entities that form part of the tax group. Once formed, the tax group is treated as a single taxable person, with the parent company responsible for the administration and payment of corporate tax on behalf of the group. For the period they are group members, the parent company and each subsidiary will be jointly and severally liable for the corporate tax obligations. And this joint and several liability can be limited by applying to the FTA. They need to go to the FTA. They need to tell them that this joint and several liability, we do not want to spread it across to all the entities. You can either cast it on me or these two entities like that. So the tax group will be treated as a single taxable person, and only up to 375,000 on the collective, on the entire group revenue, group taxable income, up to 375,000, 0% tax will be applicable. Beyond 375,000, 9% tax will be applicable. To determine the taxable income of the tax group, the parent company will have to consolidate the financial accounts of each subsidiary and eliminate transactions between the parent and each subsidiary group member. Now, what are qualifying group? I have explained to you that tax losses can be transferred, provided they fit into the definition of qualifying group. That means a tax loss of one company can be transferred, can be adjusted against the profit of another company if they fit into the definition of qualifying group. Now, what is a qualifying group? It exists where all the following conditions are met. The members are juridical persons which are UAE resident or non-UAE resident persons that have a PE in the UAE. Either owns 75%. Either owns means if there is a two company, either company can hold 75% or more share capital in company B, or company B is holding share capital to the extent of 75% or more in company C. In that case, if either company owns 75% or more of the other, or the third party owns 75% or more of the both entities, this condition gets attracted and qualifying group can be formed. So neither member is an exempt person nor should be a qualifying free zone person. And members participate again, similar conditions, what we have seen in tax group, similar conditions is applicable here as well. They should follow the same financial statement, same accounting standard should be followed. Similar financial year is what they need to follow. And then the companies which are part of qualifying group can transfer assets, liabilities, and losses between themselves. Now, what are those financial records which the companies, which the businesses needs to maintain in the UAE? Taxpayers are expected to prepare and maintain financial statements for the purpose of calculating the taxable income. So they are required to maintain financial statements. They are also required to maintain documents, supporting documents and records for the information which they have filed in the corporate tax return or in any other filing made to the authority. Exempt persons are also required to maintain all records, and records and documents should be kept for at least 7 years following the end of relevant tax period. Now, let us try to understand few of the administrative principles or provisions of the UAE corporate tax law. Self-assessment tax regime. So, whatever taxes the company has to pay, the business has to pay, should be under the self-assessment tax regime. What is self-assessment tax regime? Almost every one of us know. It's a regime where the taxpayers are responsible for calculating, for reporting and paying taxes. All taxpayers, as prescribed by the minister, will be required to register for UAE corporate tax and obtain a corporate tax registration number. FTA may also request certain exempt persons to register for UAE corporate tax. Taxpayers are required to register before they file their first corporate tax return. There is no registration threshold for UAE corporate tax. So you cannot go, you cannot tell them that my income is less than 375,000. I will not go and register and file tax return. Irrespective of your income, irrespective whether you are having losses or profit, you need to register, you need to file your corporate tax return. When do you need to file? The law says within 9 months. So the due date is 9 months from the end of relevant tax period. You need to file your corporate tax return. If in case there's a tax liability, you need to pay your tax. You need to settle your taxes before 9 months from the end of relevant tax period. Now, taxpayers are required to file a corporate tax return irrespective of the level of income, and UAE businesses will not be required to make advance. So there are no advance tax provisions in UAE. The corporate tax liability for a tax period will generally be due for payment by the end of 9th month following the end of relevant tax period. So what we understood is, although there is a concept of withholding taxes, the withholding tax rate is kept at 0%. So there is no compliances as regards TDS return filing, TCS return filing. There is no compliances as regards advance tax payments. So whatever tax liability the businesses gets, they have to settle before filing their tax return. So 9 months is what the due date is prescribed in the law. So similar to other taxes in the UAE, businesses will be subject to penalties for non-compliance with the UAE corporate tax regime. So Organization for Economic Development, Pillar 2. What is this Pillar 2 and how far the UAE government or the UAE is willing to adapt this Pillar 2? As I've told you, UAE has become the member of OECD, PEP's inclusive framework, and Pillar 2 prescribes that all large multinational companies should be taxed at a global minimum effective tax rate of 15%. So until such time as the Pillar 2 rules are adopted by the UAE has agreed to it that yes, we will implement this rule. But until this rules comes into force, multinationals will be subject to corporate tax under the regular UAE corporate tax regime. Although Pillar 2 says that no global minimum effective tax rate for multinational. What is multinational company? Multinational company is a company wherein they have got presence in more than one country and their global revenue is equivalent to or more than euro 750 millions. So if it's a multinational company, as per OECD Pillar 2, the company taxable income has to get taxed at the rate of global minimum effective rate of 15%. But until that point of time when the UAE adopts to that or comes out with the Pillar 2 adoption rules, even multinational companies are subject to tax at a regular rate of 9%. Now, coming to this last point or last chapter of my today's presentation, what are the opportunities which are available for professionals like you and me? Well, there are numerous opportunities in UAE. As you know, the law looks similar to what we have in India. The law has got provisions which is similar to what we are actually practicing in India, right? So there, once you probably, I feel that you must have understood the basics of the law with the help of my presentation today. Now, once you understand the law, you can deep dive into the law provisions and learn at your end, become expert in this particular subject, whereby you can get great opportunities. At present, almost every company is looking for people who can advise them on corporate tax applicability on their companies. There are numerous job opportunities which are available at this moment in UAE. So if you have any connect, if you're looking for job opportunities in UAE, I would say that this is one of the best time. You should definitely see and look for opportunities in Dubai. If in case you're willing to shift to Dubai and looking for job opportunities, another option is let's say take an example for free zone companies. So free zone companies, in order to categorize themselves as a qualifying free zone company, need to have the books of account audited. So the scope of audit is improved. In fact, Indian chartered accountants can also get a license subject to fulfilling certain conditions in UAE. They can get an auditing license in UAE and then perform auditing attestation functions, certification functions in UAE. So there is no bar. You can have your company set up there. You can have an auditing license company and provide services to the businesses in UAE. You can even do a lot of businesses are there. They look forward. They look for accountants or outsourcing their accounting work to chartered accountants or professionals. So that opportunity is also there. Once you understand the nation, once you understand what are the various laws which are there in the UAE, probably you can help your clients in making their books ready, in making their books of accounts ready, and do the accounting stuff. Consultancy is also again one such thing which you can perform in UAE. You can become a consultant. You can provide consultancy from India. You can have your consultancy license in UAE, have your company floated in UAE, and then provide consultancy services. You can in fact collaborate and you can look for expansion if you have presence in UAE, if you have network, or if you have any people or chartered accountants in UAE who is looking forward for someone who has knowledge on the corporate tax law, who has knowledge about UAE taxation, how the companies work in UAE, you can collaborate with them and probably take work on outsourcing basis. So considering the kind of opportunities available for professional, we had a discussion at our ICA Heather chapter along with our honorable chairman, Sir Satish Bhai. We thought of taking up this session, and I hope this, because of this session, I could add certain value to the knowledge what you possess, on UAE corporate tax, or you must have got a brief idea about the UAE corporate tax provisions with the help of this session. Thank you so much for your patient hearing. Although, in order to understand the law, probably you need to attend a lot of sessions wherein we can discuss upon various provisions in detail. In today's session, what I did is I tried covering the entire law provisions in order to make you understand that what are the various provisions which are there in law. It is next to impossible to cover all the provisions in one session of around 2 hours in a webinar. But still, I have made an effort to make sure that at least you will get an overview or a bird's eye view of what the law provision says, how you can help with the help of this knowledge your client, or you can assist your clients or potential clients in UAE. With the help of this basic understanding, now it is up to you to deep dive into the various provisions of law, understand the law in a more detailed fashion, read it. You will find law, the BAIR Act, the ministerial decisions, the cabinet decisions on their website, FTA website and Ministry of Finance websites, wherein a lot of articles, lot of law material is available. You can go through it. You can try to understand. If in case you have any query, I'm always available on this email ID and number. Please feel free to get reach out to me. I'm always there for you guys. Thank you so much. Thank you so much once again. Over to the committee, please.
Yeah, thank you. Thank you, Shailesh. I think in chat there is one question if you might
Yeah,
want
sure.
to take it.
Yeah. Can you read out the question for me,
Yeah,
please?
it says, Sir, will corporate tax tax registration be required for non-resident sellers in UAE? Example, selling through Amazon.com. I have taken a UAE VAT as a non-resident. There is no PE, but I pay VAT on sale in UAE.
Great, good question. So for non-residents, if you have a UAE sourced income, in this case, you are selling your products through Amazon kind of platforms. Now, if you have a UAE sourced income, and if you're a non-resident and doesn't have a PE in the UAE, you need not have to register in the United Arab Emirates. However, there is a concept called withholding tax, which is applicable at 0%. So maybe going forward, the payers might deduct, some taxes in the form of withholding taxes. But as on date, the withholding tax rate is 0%. You need not have to pay any taxes there since you are a non-resident and doesn't have a PE. Need not even have to go for registration as well.
Okay, there's one more question here. Just by owning an IPR makes excluded activity, or should an QFZP earn revenue from IPRs like royalty, etc., to be treated as excluded activity? To
Good question.
elaborate,
Yeah,
yeah.
yeah, I
Anyway,
understood.
there's,
Now there
there's
is a
a big
qualifying.
part
Yeah.
B to the question, Shailesh. Should I read the entire question?
Yeah,
Okay.
yeah, please, please.
To elaborate, if FQZP holds IPR but does not generate any revenue from IPR, can take the benefit of 0% taxation on the entire income, which is qualifying income under distribution activity.
100%, 100%. Until unless you have this activity which fits into the definition of excluded activity. Excluded activity says you are actually doing transaction, okay, on that particular activity. Now here you have a patent, you have a copyright, but you're not getting any income in that. So until unless you get any income, the definition or the understanding of non-qualifying income doesn't arise. So when there is no income, there is no non-qualifying income. And when there is no non-qualifying income, whatever income you get in UAE as a qualifying free zone person, you can pay tax at 0% only. You need not have to pay any taxes because you're not getting income from excluded activities. So income, receipt of income is mandatory.
One more question. He says also, is there any chance of treating the high sea sale as qualifying activity under distribution activity?
Yes, in fact, FTA has taken a session last month, not last month, basically a couple of weeks back, wherein, although in writing, it is nowhere mentioned that high sea sale is considered as a qualifying activity. But in that session, which was a physical session which was conducted by the FTA, one of the delegates has raised this question, and the answer given by the FTA was this. They said all the high sea sale transactions will be considered as a qualifying activity, meaning thereby you can have a company in free zone, you can perform qualifying free, you can perform high sea sale transaction and avail the benefit of 0% corporate tax rate. Although we are all as professionals waiting for the official, writing from the FTA, either in the form of clarification or guidelines from cabinet or minister, we are expecting a detailed guidelines on this. But yes, FTA delegates has said that high sea sale transaction will be considered as a qualifying activity.
Good. There's one more question, Shailesh. Is it required to pay expenses through bank for deduction from taxable income, like India having cash limit for expenses?
As per UAE corporate tax law, there is no restriction as regards cash payments towards your expenses. However, there are few other laws which restricts the cash payments. There is economic substance regulations which is applicable to the UAE entities. There is country by country reporting regulations which is applicable. There is AML, anti-money laundering provisions which are applicable, which restricts your cash payments. There is a limit to it, which I'm not able to recollect right now. But yes, as per law, there's no restriction. But as per other provisions, there is a restriction of cash payments. Of course, it is not as less as 10,000 INR, which we have in India. But yeah.
Okay, cool. That's it, Shailesh. A lot of people congratulating you, and I think a big round of applause.
Thank you so
I
much.
yeah, the response also has been overwhelming, and that was the reason. The moment the program started, we had more registrations coming in, so we took the liberty and put a YouTube link as well for people who could not get onto the Zoom call.
Okay,
And and a lot of people are requesting for the PowerPoint presentation.
I'll share it to you. Yeah,
Yeah, please email it to the branch mail or even my mail ID. Maybe tomorrow we will get it hosted on the website. It will be in the resources section. Okay, you can go
perfect,
to the
perfect.
Hyderabad website, go to the resources section, and there you will find uh, all of our speakers generously contribute their presentations. So whatever programs have happened during the year, all the presentations are there till the year end in the resources section. So anytime you can go and have a look at it from there. Indeed, it
Great,
was a
we'll do it.
great, yeah, indeed, it was a great session. I mean,
Yeah,
I myself, I was skeptical that after a long time we are going a webinar mode. I mean, we are all used to meeting in person and having samosas together, but I myself was skeptical. But yeah, great presentation. Good attendees, a lot of attendees, and as a token of appreciation, love, and affection from Hyderabad branch, and on behalf of Hyderabad branch, we'll have this certificate of appreciation for you,
thank you so much.
Shailesh. We'll make sure this is
Thank you so much.
printed and. We'll get this printed and maybe you know whenever you are at branch or maybe we can send it across to you. Thank you so much
Thank you so
for
much.
yeah for this and maybe depending upon the requirement if people come up with more requirements on this, maybe we will plan one more session in physical in a bigger auditorium because the
For
response has
sure.
been really overwhelming and you spoke really well.
Thank you so
Thank
much.
you,
But the challenge for me was to cover all the provisions in 2 hours of time. I mean,
yeah.
it was next to impossible, but I tried my best.
I understand. I mean, like you say, institute has a certification program also. At least if this triggers the switch to go and attend, that also is see right now. If you see really work and getting a lot of work in India because India is going with a lot of automation. So what
Yes,
was yesterday a work for us, today's system on click of button is doing it. So we need to explore newer markets and we need to explore newer boundaries for us to really monetize on the knowledge and this has come in the right time, I think. UA corporate taxation has come in the right time, and Shailesh has come in the right time, with his certification course also. So I think
yeah,
this is an awareness for people also to. I mean, definitely the institute ICI certification only. You were talking about, right? In the
exactly.
initial.
The direct tax committee has come up with that certification course. In fact, I would really appreciate if members can, participate. If in case the next batch is announced, as on date it's not yet announced, but if in case the next batch is announced, you must attend that so that because India and UAE are more like traveling to Dubai is like traveling to Mumbai and Delhi.
Yeah,
And
it's barely
almost
three
every one
hours.
of us, yeah, every one of us has got connects in Dubai and across all the Emirates of UAE. So the
Especially
opportunity is
for
great.
town like Hyderabad, we have a lot of edge. A lot of our people are
Yeah,
there, and even the food people from Hyderabad can get accustomed. And I
exactly.
think I think it's a good point you suggested. Maybe if a lot of members are interested in that certification program, please write into the branch or to the institute in any which way. Let us try to have one more certification program like that based out of Hyderabad only. So it will be
Yes,
beneficial for all of us. We really need to break the barrier of the borders and there is a lot of acceptance for Indian chartered accountants based.
oh yeah. Indian chartered accountants are there in almost every company in UAE,
Yeah, yeah,
leading at a very leading positions. And
yeah.
people of
Even
UAE, they
before
look at chartered
taxation was
accountants.
there, even then
Absolutely.
for accounting also, we are the most preferred. I think we
Most
are the
trusted
most,
and preferred.
yeah,
Yeah.
preferred people. And so now with the taxation also coming up, the boundaries and the opportunities have increased, not decreased. So maybe we should ask institute to, have one more certification program based out in Hyderabad, so
Yeah,
that it
if
will
in case we get interest from the members, probably for free zones we can have a one session. For transfer pricing we can have one session. For PEs
yeah,
we can have one session like that, because in itself each of these particular provisions is like we can write books on it. So
exactly,
yeah, so we can have
exactly.
separate sessions for separate chapters of this
We
law
will, Shailesh, we
based
will
on the interest of the
definitely do
members.
that.
Yeah.
This is a most welcome suggestion. Maybe you can help us and guide and be the guiding star in terms of, like we just started today by
Yes.
calling it demystifying and, just beginning.
Yeah.
Maybe we will have a series of programs. Maybe we can launch 3 or 4 programs together over weekends, and maybe we can help people, because what I have seen based in Hyderabad is a lot of people are already doing a lot of work in UAE, and
Yes.
this kind of a learning will definitely help a lot of us. Okay. It
Yeah.
was a great session, Shailesh.
Thank
Thanks
you
a lot.
so much.
And now you are our go-to person for UAE taxation. So we will keep
Anytime.
troubling you more
Anytime.
and more
Anytime,
to
Rajan.
come and
Pleasure.
help.
Pleasure is mine. Yeah.
Yes, yes. Thanks.
Thank you.
Thanks a
Thank you
lot.
so much, all the attendees. Once again, thank you so much for being there till the last moment. It's really encouraging, and I really appreciate your presence. Good to see Girdhari Bhai on board.
Thank you.
Thank you, sir. Thank you so
Thank you
much.
so much.
Thank you.
Thank you, Sailesh. Thank you so much.
Thank you. So I'll take leave.
Thank you.
Yes,
Take care.
yes.
Bye bye.
Bye.
Yeah.
Bye.